Section 6, Leverage and Margin, with Theory MT5 Practical Application. This section is going to help you understand the concept of leverage and margin in forex trading, how they amplify risk and reward, and how to manage them practically in MT5. A. What is leverage? This is another part to pay attention to. What is leverage? Leverage is an amount of money that a broker lends to you that allows you to control a larger position with a smaller amount of your own capital. I'll read it again. Leverage is an amount of money that a broker lends to you that allows you to control a larger position with a smaller amount of your own capital. It is expressed as a ratio. Example, 1:100 ratio, or 1:500 ratio, or 1:1000 ratio. 1:100 ratio leverage means you can control $100,000 with just $1,000 of your own money. So let's say you have $1,000 to start your trading or to deposit into your trading account. If you choose a leverage of 1:100, you are being given $100,000 as your capital to trade, which is going to help you to win more if you know what you're doing. At the same time, it's going to help you lose more if you don't know what you're doing. Leverage amplifies both profit and loss. If you look at the diagram here we have 2 coins, and here we have a lot of coin here. The 2 coins you have here is your money, that is your capital you've deposited into your account, and the one on the other hand is what your broker, the amount your broker is lending to you, so that you can be able to hold trades or open trades bigger than your initial deposit. B. What is margin? Margin is the amount of money required in your account to open and maintain a leveraged position. A margin is an amount of money required in your account to open and maintain a leveraged position. It is not a fee. It is a portion of your funds held as collateral. Example, with 1:100 leverage, $1,000 trade requires only $10 of margin. So looking at the diagram here, we have required margin, which is $200, and here we are using a leverage of 50.1 leverage. National value is $10,000. How leverage and margin work together? 1. Higher leverage is equal to lower margin required. So if you choose higher leverage, which means the margin that is going to be required for you to hold a trade will be little. Lower leverage is equal to higher margin required. After that, we come to used margin. This is a money reserved to support open positions. This is a money reserved to support open positions. After that, we have free margin. It is money available to open new positions or new trades. We are going to do all that or check all that on the charts so that we know exactly how they work in real time. Margin level is equal to equity and used margin times 100. If it drops too low, your broker may close your positions, which we normally call margin call. If you have been trading for a while, anytime your account is low and the trade is going against you, your broker will send you a message, either a text message or an email, and you will see that at the section where you see your margin, equity, and everything, the whole numbers there will turn red. That means your account is in danger, and this can lead to the brokers closing some of your trades so that you don't lose a lot of money or be indebted. D, we have risk warning. High leverage. When you choose high leverage can wipe out your account quickly. 2. Always use leverage with a solid risk management strategy. Leverage is good, especially if you don't have much startup capital. You can use leverage, but you must know your way around it with a proper risk management strategy. Here we are going to talk about swap. Most of us has been trading, but we don't know what a swap is. In forex trading, a swap is also called a rollover. It is the interest you either earn or pay for holding a position overnight. How swap works. Every currency in a pair has its own interest rate set by its central bank. When you buy one currency and sell another, you are essentially borrowing one and lending the other. The difference between the two interest rates determines the swap. Two types of swap. One, we have swap long, when you hold a buy position overnight. Two, we have swap short, when you hold a sell position overnight. For example, you are trading Euro USD. Euro interest rate is 4%. USD interest rate is 5.25%. If you buy Euro USD, you are borrowing USD at 5.25 and earning Euro at 4%, which means you will be owing 1.25 since the USD is 5.25. So you are paying a negative swap. If you sell Euro USD, you might earn a positive swap because you are borrowing Euro at 4% and earning USD at 5.25. I believe we can all remember when we spoke about the base currency and quote currency. The example given here, we can see that the Euro interest rate is 4% and USD interest rate is 5.25. So if you should buy the Euro USD currency pair, if you buy it, which means you are trying to say that the Euro is going to dominate the USD overnight. If that happens, you will be having a negative swap because the interest rate of the Euro is 4% and the interest rate of the USD is 5.25. But if you should sell that same currency overnight, you might earn a positive swap because you are borrowing Euro at 4% and USD at 5.25%, which means you'll be making 1.25% swap instead of negative swap. In this case, you are going to be having a positive swap. When are swaps charged? This does not happen all the time, but there are some particular times that it happens. When are swaps charged? At 5 p.m. New York time, the end of the trading day, and Wednesday carries a triple swap to account for the weekend. Where to see the swap in MT5? Right-click on a symbol in the market watch specification. Look for swap long and swap short values, or here. When you look at the diagram, you will see where the arrow is pointing. That is where you see your swap on the MT5 desktop. F. Key takeaways. Leverage increases both opportunity and risk. Margin is required to open and hold trades. Proper margin management is equal to account safety.